Governments everywhere are drowning in debt, and they need anyone, to buy it. But with investors getting cautious and central banks backing off the money printer, they're running out of options. We keep hearing, inflate the debt away or default. But there's a third option, one that's subtle, powerful, and a little bit sneaky. It's called financial repression, and it's quietly making a comeback. In this video, I'll show you exactly what financial repression is, why it's back in action, and what you can do to protect your wealth before it's too late. Let's get into it. To understand where we're heading, we need to look at the past. Financial repression is a set of tools governments use to deal with debt without cutting spending, raising taxes, or causing runaway inflation. Instead, they keep interest rates low, lower than inflation, so they can slowly shrink what they owe at your expense. Your savings, they lose value over time. It doesn't stop there. Governments also push banks and pension funds to buy their bonds, even when it hurts. Create rules that trap money inside the system. Make it harder for investors to move their cash abroad. This isn't theory, it's history. After World War II, countries like the US held interest rates down for years, and their debt just melted away. But savers, they paid the price. Fast forward to today. We've got soaring government debt, aging populations, massive spending demands, and a world hooked on low interest rates. According to financial historian Russell Napier, we're moving from monetary dominance to fiscal dominance. In simple terms, governments, not central banks, are now calling the shots. Keep interest rates low. Make the banks buy our bonds. Don't let inflation get too high, but don't stop it either. Sound familiar? This isn't about growing the economy. It's about survival. Europe is already doing it. Banks are being pushed to load up on government bonds, even if they lose money in real terms. Japan? Possibly the first advanced economy to openly embrace repression. The Bank of Japan is signaling policies that force domestic buyers to absorb more debt. And yes, this can go further. Napier warns, we may even see capital controls, limits on how you move your money. Sounds extreme? It's happened before. So, what does this mean for you? Let's start with the losers. Cash savers, bondholders, anyone relying on fixed income. Your money might look safe, but if it's not keeping up with inflation, you're slowly bleeding purchasing power. Banks and pension funds? They're under pressure too, forced to prioritize the government's needs, not yours. And equities? Even they're not immune. If large asset managers are pushed to buy more bonds, they'll have to sell off stocks, especially big index names. So yes, being passive can actually be risky. Are there alternatives? Sure, but none are easy. 1. Austerity, too unpopular. 2. Default, too risky. 3. Free market reforms, politically unlikely. 4. Global cooperation? Yeah, good luck with that. That's why Napier believes financial repression wins by default, because it spreads the pain, just slowly enough that most people don't notice. Napier doesn't expect a sudden crash. He predicts a market melt-up first. Asset prices rise, inflation climbs, then the rules start to change. Asset managers will be forced to rotate into government debt. Private capital gets siphoned off, bit by bit. The result? A long, slow bear market, engineered by policy. To survive this, you need to move away from passive strategies, diversify across geographies and asset classes, hold hard assets, look for value stocks in favored sectors. The key takeaway? Financial repression is not a temporary policy. It's a regime shift. Don't assume yesterday's strategies will work tomorrow. Stay alert to inflation. Protect your purchasing power. In this new era, being passive might be the greatest risk of all. If you found this breakdown helpful, hit that like button and subscribe. Thanks for watching.